What's up, investors? It's the Russian dude, the one and only source of capitalistic communism and communistic capitalism in the world. Today, thank you so much for joining the live stream. Today we'll talk about, as always, about at least two major things that are happening on the stock markets. And today, once again, in the beginning of the stream, I will go over my portfolio really quick, just to see how my portfolio performed during the week. And just a quick heads up, it did not do well, but it was not like -5-10% in 1 week or something like this, so it is bearable. It did hurt, but it is bearable. And next Tuesday is my time when I'm opening my third portfolio. We'll be investing in majority of completely new companies. So my third portfolio, which I'll be opening next week, will have, I think, only one company that I currently have. All the other companies will be brand new. And during my next stream next week, also obviously Friday, same 5 p.m. Eastern Standard Time, I will show you what are these my new companies and I'll explain why I bought them. So next stream, let's do it basically overview of my portfolio, plus obviously some major stock market and financial news and economic news. In today's stream, after we go over my portfolio really quick, I will go over what I think might crash the stock market. As cringe as whatever it sounds like, maybe people are like, okay, we're already tired of your all stock market crash predictions, it's never gonna happen, people will just keep investing in stock market, Federal Reserve will just keep printing money. Yes, this might happen, but the question is it sustainable? Is this sustainable? And if it is, how long more we can see all this money printing thing going on? Because in this video I will show you, today I even did a small presentation, so hopefully, at least hopefully, this time it's gonna be a little bit more professional. And I'm trying to make my stream to be better than the previous one. And hopefully more concise, less repetitions, which I know is the bad thing about me. I'm keeping repeating 5, 7, 10 times in a row the same stuff. I will try to be more aware of what I'm saying, so the stream will be full of information. Okay. So today, as always, let's start with my portfolio overview. Just as always, let me log in really quick into my Wealthsimple portfolio. Then we'll go over my positions and how they performed during the week. Basically standard procedure. Okay, in the meantime, I want to thank you all so much for joining while my Wealthsimple is logging in. And I want to ask you, how was your week? How was your week? Did you enjoy it? Are you excited for the long weekend which is in ahead? Because if you're from USA or if you're from Canada, we have 3 days of vacations. So tell me about your plans on the weekends in the meantime while I'm logging into my Wealthsimple. We are almost done. So far, everyone is shy, looks like, no one wants to say, but that's okay, don't worry. I'm the one who is entertaining here, I'm the one who is presenting, so that's okay. Okay, so Wealthsimple is logged in. And TFSA, now let me start sharing. I'm still not sure if my hotkeys are working, so I'll need to do it manually. Okay, TFSA. It is up 3% in comparison to the previous month. So far we are doing okay, because 3% in 1 month is a big, obviously, return, but obviously it's not sustainable. So it is obvious that this week majority of my stocks, not majority, but some of them went down. So as you can see, in comparison to the previous week, I'm down $50, which is 0.00 something. As always, Wealthsimple rounds up the numbers, so I cannot see exact number, but to be honest, it is well better than I expected. I thought I'm gonna be down more than this, so just $50, it's not a big deal. Okay, and we'll go over individual companies really quick as always. Apple is up 4.6%. This is a pretty surprise, a very good surprise for me. AbbVie is down. AbbVie is the one that made my portfolio not collapse, but AbbVie went down a lot. And look at this. AbbVie is down 7.25%. And the reason for this, it is because FDA, the Food and Drug Administration agency in the USA, it did not approve one of the drugs from AbbVie. It just delayed its approval because for further, let's say, so for further investigation. Very basic summary of what happened, but basically AbbVie had a drug that was going on in the market, and this was supposed to be one of the biggest also sources of revenue in the future, because right now AbbVie has very good diversification, but one of the drugs that AbbVie produces has pretty big weight in whole overall revenue of AbbVie. And this new drug that was not yet approved by the FDA was delayed by FDA approval. And for this reason, as you can see, the stock went down in the moment of about almost 10% in literally 5 minutes. But nothing significant changed. Drug is still in the development, and most likely in the future it will be approved, which basically means that the stock of AbbVie must go up. And now is the very good opportunity if you're into biopharmaceutical sector, in the healthcare. Now it can be a good idea to dollar cost average into AbbVie and maybe even reduce a little bit your cost basis of this position. But for me, this is most likely 100%. This is my biggest loser of the week, and it is down 7%, even more than 7%. Okay, next one is AMCR, my biggest dividend payer, and I'm assuming it's around 0. It's down 0.16%, not a big deal. Next one is ARK. This is the last day I'm having ARK in my portfolio, because on Tuesday, the next day after the markets are opening, I mean the same day markets are, because on Monday is going to be, by the way, Monday is the Labor Day, so Canadian and the US markets will be closed. So keep this in mind. On Monday you will not be able to buy stocks in the regular trading session. If you are doing like pre-trading or after hours trading, maybe you will be able to do it, but markets will be closed on Monday. And on Tuesday, I'm getting rid of this ARK Investment Management Innovation ETF. And this week, hopefully, yes, it's up 4.5%. So it's my very last quick gain. Hopefully on Tuesday, it will not go down significantly, so I can just sell it, lock in my, whatever it is, Total gain is approximately 10%, yes, up 10%, so I'll take it. I'll take $183, like it's not a big deal. Next one is Bank of Montreal, financial sector obviously, and the position is down 0.05%. I'm down 7 cents on this company. Next one is Caterpillar, and this is down 0.89%, not a big deal as well. Next one is Carnival. This one is also down. It's only down 2.59%. I was expecting it to be more down, but that's okay. Next one is Corsair, one of the companies that I will be buying next week. And of course, because I'm going to buy it next week, it went up by 5.5%. If you've been watching my previous streams, every single week Corsair was going down and down and down and down and down. And just when I need to buy it, it goes up. So now I will probably have to buy it with like 5, 7, whatever is going to be on Tuesday, percent premium. But overall, in 1 month, it's still up. Oh, well, but that's okay. I'm gonna buy, looks like more or less at the same level. So hopefully on Tuesday it will go down a little bit, and then I'll be more than happy. Okay, next one is Intel, and Intel is, let's see, I'm not even sure. Okay, it's up 0.28%, not bad. Next one is Lockheed Martin. I think it's around 0 as always. It's down 2%, but that's okay. Next one is Southwest Airlines. This must definitely be down, and yes, it is down 2.88%. And the next one is 3M Company, which is down 0.82%, almost 0 basically. Next one is Nordic American Tankers. Finally, I was able to wait until the report. I was waiting, you remember this company that went down significantly. In the last year, it is down 32%. In the last 5 years, it is down 75%. But company from financial statement standpoint is not bad, it's decent. And because freight rates are so expensive right now, it's so expensive to transport everything by sea, by ships, by containers, I was expecting that the financial report will be extraordinary. And taking into consideration that this stock is down more than 70% when is this? It's like, no, okay, in 5 years, I was expecting that if the report is good, the stock might explode, which unfortunately did not happen, but that's okay. It is still up, if I'm not mistaken. Yes, it is up 9% in just comparison to the last week. But this company, I only have it like, I don't know, 1%. Yes, it's only 1% of my portfolio. So this 9% growth, it was only 0.9%. Overall, it affected only 0.9% approximately of my total portfolio, maybe even less than this. So the next one is, oops, it's not this one. Next one is Nucor, the one which is still manufactured but been correcting itself most likely. Yes, it is down 4%. I was looking forward to trim a couple of shares of this company, but looks like it was already going down. So I will need to see what's my newest portfolio percentage of this company inside my portfolio, and then I'll decide to trim it or just leave it as it is. And just a couple of more, renewable energy, another company that I'll be getting rid of. It is down 6%. This has been a very huge disappointment of a company for me, unfortunately. At the time I was buying this, I did not do too much research, and now I'm paying for this. But this is the company that I'll be replacing with the renewable energy ETFs, which I will talk about more in details during my next live stream. And the last company is the store, which is the REIT, real estate investment, basically a company, and this is up 1.72%. So this was my portfolio. As you can see, overall, I just lost about $50 in one week. And this is based on the almost $21.7 thousand, so it's like not a big deal. This is the amount of money that goes up and down every single day, so I'm not gonna be worried about this or lose sleep over it. My second portfolio is approximately, it has the same companies. I'm not gonna go over this because it's pretty much the same companies and it's the same performance. So that's my whole portfolio performance as it is as for now for this week. Okay, and now what we came here for. I think I'm still sharing my screen, yes. So now let's talk about how do I start the slideshow. Okay, now let's talk about why I think the stock markets might crash and what it can be the reason of this stock market crash. And let me see if you can see everything. I think my portrait, my picture is blocking a lot of things, but you can see the most of it. So in case if you cannot see something because of me blocking everything, just let me know in the comments and I'll remove myself, so you will be just able to see the presentation. And also let me know how it looks. I did it like in 5 minutes. I just put graphs on very basic background that I literally did in 2 minutes in Photoshop. So just to have something a little bit more professional than just sharing the screen when I'm just showing the pictures or whatever. Okay, so a little bit backstory from the previous week for those of you who just joined. Thank you, Lila. Thank you for confirming that we can see this stuff. You can see, I mean, this stuff. Okay, first of all, the last couple of weeks we were talking about stock market potential crash. We were talking a lot about the container rates, which I also even talked about like 5 minutes ago. Now I was talking about Nordic American Tankers Company. Rates of transporting things by sea, by these big shipping containers, becoming extremely expensive. It is, in some cases, it's ridiculous. As you can see, some prices went more than 10 times than they used to be. On average, I think it is 4 to 5 times more expensive to transport goods by the sea. And this is just one of the basically rates of like Los Angeles to Shanghai, New York to Rotterdam, and basically you see all the other Rotterdam to New York and all this kind of stuff. As you can see, lots of shipping from China to the USA and to Europe literally skyrocketed into the stratosphere. And where the majority of goods come from China, from India, from this region. And look at this. So if the rates are 4 or 5 times more expensive, this means it's additional expenses for companies that produce goods, and they need to buy raw materials or finished goods from China. And now shipping will be so expensive, and obviously they will pass this cost to us consumers. So this is one of the sources of the inflation, which is according to the last week, this previous month already in August, it was 5.4%. So container rates is the first thing that was very concerning about, because companies that still do not make money, if you remember from last couple of streams, and now they're struggling already, and now the rates are so expensive. They need to save every single dollar, and now costs just to deliver even goods, just to even start producing are so expensive. So where these companies will get their money from to even pay for the supplies? Of course, this can potentially and most likely already started doing some waves of bankruptcies among like some of these smaller companies, which basically means that small unprofitable companies started closing their businesses. Then even more companies have started closing their business because that's it, they cannot just survive. Everything is so expensive and people do not buy too much stuff anymore. And speaking about people buying less stuff, I do have a graph a little bit in the future in this presentation, so you will see that even the consumer confidence is declining, but about this in a while. This is the next one. Besides, this is the next graph. Besides everything is being so extremely expensive just to transport things by sea, so many ships cannot even get unloaded. As you can see, number of anchored container ships waiting to offload at Los Angeles Long Beach. So the ships, they come with the goods, and now they're just staying there because there is like ports are at full capacity. There is not too many people working in the ports because of the virus regulations, like 6 feet distancing, social distancing, and all this kind of stuff. And there's not even too much workers because people are willing less to work because they just were getting free money from the government for the last year. And now some people just decide not to work or just live on the unemployment benefits and stuff like that. So long story short, all these and even more led to even container ships just staying, waiting to be offloaded. Which means what? Once again, companies cannot get their goods. So companies which are already struggling to make their ends meet, and now they cannot even receive their goods to at least start selling them. And this is the next thing, the next graph. It's production index versus new orders index. As you can see, production index is the orange graph here, and the new orders index here is the black line. More or less since December 2012, it was more or less going in accordance, it was going in the same direction all the time. But since this so significant supply chain shortages, including but not limited to semiconductors, companies just cannot produce stuff. There are so many orders. People or other companies and other manufacturers, they want to buy stuff from another companies, from their suppliers or whatever, but just because there's so much shortage, there is not too many container ships and the rates are so expensive, the companies cannot produce that much to meet the to meet the demand requirements. And this gap, as you can see, it's the first time almost in a decade that we can see this pretty much big gap in production versus new orders. And now, once again, speaking about reverse repurchase agreement. Reverse repurchase agreement, long story short, is when the banks, they have so much money, they do not know what to do with this. People do not get too much loans anymore. And what happens? Banks receive money from the government, they don't know what to do with this, and they give money back to the government overnight just to get 0.05% return on this money. And this is what is called basically reverse repurchase agreement. This has been skyrocketing once again, at least since the 2017, whatever we see on this graph. And this has been incredible because there is so much money in the system. Banks absolutely have no idea what to do with this, and once again, governments just take money back and give even more money back to the banks, which is like, once again, it's 0.05%, and the amount of reverse repurchase agreement is 1.2 trillion in 2 weeks ago. At this very moment, I think the very latest reverse repurchase agreement was for $1.09 trillion. So now we're approximately $110 billion less, but it is more than $1 trillion overnight that governments get back just to pay them back to the banks the next day with 0.05% interest. What it tells us? It tells us that it's so much money into the system and no one knows what to do with this. And at the same time, it's not even getting too much use of it. So it's not even that useful anymore to continue printing this much money. And this is what happened with the real 10-year treasury yields after the Jerome Powell last week symposium in Jackson Hole, which was exactly 1 week ago on Friday. And this is when he said that most likely they're not looking forward to start tapering, to basically stop printing money. What he meant is that they will continue printing money until they see extremely stable economy, which at least means that he will see that the jobs are back, that people are starting being employed, that unemployment rate goes down, and all these employment related things. But even though we kind of see that the employment is back, and once again, I do have a graph about employment in a couple of slides later, but it's for him, it's still not enough. It looks like he wants to see 100% employment. He wants to see every single person to be working before he wants to stop printing money, which obviously it's never gonna happen, and it's not true, but it just feels like. What it feels like even more is that at this very moment, Jerome Powell, the Federal Reserve Chairman, his duty as a Federal Reserve Chairman is until February 2022. And what a lot of people on the internet are saying, including me, and not just internet, just in the world, people are saying, is that because as soon as money printing stops, this can potentially lead to the start of the recession, of the crash, of the correction, whatever you want to call it. And he just does not want for this to happen, because he wants to finish his term on basically with the good and save his reputation. What he wants is to just survive until the end, and then either he gets re-elected, or maybe it's another person gets elected to be Federal Reserve Chairman, and then whatever happens after this, whatever happens, he's not a part of it. If he gets re-elected, yes, he might still stop printing money. Not obviously, he's not going to stop it immediately. He's going to do it slowly. So instead of printing, let's say, $120 billion per month, he's going to do like $100 billion, then 80, then 60, and so on and so forth. But whatever he is doing right now is just not to allow this thing the crash to happen, while he is still in power. He wants to finish on good terms with the president, with the government, with the whole, basically, the whole USA. After it's February, after he's either elected or no, this is when we potentially can see some things changing. But whenever he announced that for now they will keep printing money, which you remember, they do not get too much, they do not bring too many benefits as much anymore. But he said that he still said, not directly, but he mentioned it was pretty obviously, that they will keep printing money for now. And as you can see, real yields of 10-year treasuries basically went down significantly, which means that if you remember from, once again, my last stream, whenever the yield of bonds goes up, it means that the price of bonds goes down. And whenever yield goes down, the price goes up. And the reason why bond prices go up is when there is more demand for these bonds than the supply, which basically means that money will be printed, there will be more asset purchases, and one of these assets is the treasuries, basically. And if there is more purchases of treasuries, it means that demand will be higher than the supply, and the yield will go down. So no, it's a correlation. Price up, yield down. As you can see, after he announced that there will be no tapering, that they will continue printing money, yield went down. And the reason it's called real yield, it is because it is adjusted for inflation. And as you can see, really, if you invest right now in this house called like treasury, 10-year treasury yields, your actual returns will be negative. So even though it says that it is 1.28%, I think at this very moment, somewhere around that, even though it will bring you some money, a little bit more than 1% per year, in fact, adjusted for inflation, you're going to be losing money investing in treasuries, which is obviously not a good thing. And this is also the graph, this is the inflation expectations, which also, as you can see, they went up significantly after the Jerome Powell said that they're not planning to stop printing the money, and they will continue buying assets, and the inflation will continue to go up, basically. And yes, logically, inflation expectations went up. And this is what people might say, well, it's happening around the world. It's not just in America, it's like everywhere, it's in Europe. And here you go. This is the consumer price index inflation, which is one of the main inflations, the price inflation for everyday goods, like groceries, oil changes for the car, haircuts, and all this kind of stuff. In the US, at this very moment, the inflation, CPI inflation, is 5.4%. And if you compare to the Eurozone, Europe inflation, it's only under 2.5%. It's like what, approximately 2.4%. So US inflation is almost twice higher than the inflation in Europe, which basically once again says that this money printing is just keeps inflation going without providing too much benefits anymore. And as you can see, this is finally the graph that I was talking about since the beginning. This is a very important graph right here. So the blue line is economic surprise index, and the red one is the basically inflation surprise or the inflation graph. As you can see, they were relatively the same since like for decade already. They were more or less going up and down sometimes, but more or less they were kind of in the same from -100 to 100 zone. But since money printing started, and obviously virus was a very unexpected thing, no one was ever prepared to have the worldwide pandemic. So this is when huge divergences started to happen. And as you can see, economic surprise means that our economy, as you can see right here, if you can see, yes, right here, our economy went down significantly, and then it started recovering so fast. That's why there was so many economic surprises. That's why this blue line went down significantly and then skyrocketed almost vertical. So as you can see, there was so many, no one expected the economy to recover so fast. And now since the third, fourth quarter of 2020, approximately since like September, like exactly 1 year ago, it started to go down gradually. It was going down and down a little, sometimes it was going up a little bit, but it's overall downtrend. And what it means, that even though the money is keep being printed, it does not bring too much benefits anymore. There is not too many surprises. Money is infused into the system. There is reverse repurchase agreement. There is like asset purchases. Government is printing $120 billion per month. Yes, in the past this was helping the economy, but not anymore. This money is infused into the system at the same speed, but that's it. The system already recovered, let's say, so in some way. It just they want to push last, let's say. So right now, let's get this theoretical example. Let's say so in order for the economy to be fully recovered, it needs to reach 100%, which is obviously impossible. Let's say so theoretically 100% is 100% employment. It's like everything is good, there is no war, pandemic is over, everything is perfect. This is, let's say, a theoretical 100%. Right now we are around 70%, let's say, so just number out of my head for almost no reason. We're right now at 70%. Perfectly healthy economy is around like 85%. Whenever the pandemic started, in the worst days of pandemic, we were around 30%. So we spent all this money to go from 30% to 70%, and this, yes, this did help. Indeed did this help. But now they're trying to spend the same amount of money just to go from 30 to 70. We went 40% of improvement. And now they're spending the same amount of money and even more just to go this additional 15%. For this reason, as you can see, there is not too many surprises anymore, because that's it. Almost everything that needs to be recovered already recovered. There are still some problems, but they are minor in comparison to what we were facing more than 1 year ago. And because money still keep being printed, the inflation just goes up without getting any benefits to the economy. And this is once again the next graph that shows that yes, there is indeed almost no economic surprise, not just in the US, but in Europe at all. Here you go. The biggest stock market, the lowest point in the stock market was, if I'm not mistaken, March 23rd, 2020. You can check, correct me if I'm wrong, but I think the end of March, this was the lowest point in the economy. And yes, this is where we see that the economic surprises were at the lowest approximately, yes, about that time, April, May of 2020. And since then it was starting to recover significantly so fast. You remember my last slide? Because no one expected the economy to recover so much and so fast. And since then, that's it, we're kind of just in the downtrend. No new money is boosting the economy, nothing else what they're doing is making any shocking events or anything like this. So the economy just adapted to this level of money, this absolute incredibly overwhelming trillions of dollars of money that was being printed, and no one even knows what to do, just to give it back to the government to receive it the next day with like 0.05% rate. And this is what also banks are doing, because they have so much money. Besides doing reverse repurchase agreement with the government, they're also making it so easy to borrow money. As you can see, this is from Financial Times. And by the way, all the slides that I have right here, in the bottom or somewhere in the corners, there will be sources for these slides. So for example, this one specifically is from the UBS estimates. Federal Reserve, and this was in Financial Times article basically. And what this graph is showing is that banks making it so easy to get money right now. It's consumer and small business loans, basically like us, like you and me. It was extremely hard to get money, as you can see, whenever the greater financial crisis happened in 2007, 2008, and it was extremely complicated to get money when the pandemic started. But since then, money being printed, no one knows what to do, and banks started to make it easier. And guess what? Doesn't it remind you about something? Doesn't it remind you about something that happened around 2007? Around 2008, whenever it's so easy to get the mortgage, like almost everyone qualified for mortgage, people with almost lowest possible credit scores were able still to get mortgages, to get loans and all this kind of stuff. So doesn't it remind you that something similar is happening, that there is so much money, that the economy is unstable, that all the policies that they're doing, all the money infusions they're doing is not helping too much anymore. And now for this money to finally work somewhere, to finally do something at least good, they start to lend it to almost everyone. Not almost to everyone yet. You still need to prove like your credit score and all this kind of stuff, but it gets way easier right now to get money that even, let's say, so 5 or even 10 years ago. Does that remind you about something? And so this is once again the next graph, which basically confirms the same thing what I just said. This is the financial conditions index, which basically shows overall how easy is it to accumulate money, how to get money. And yes, right here I'm blocking with my face everything. So let me see if I can quickly just show the screen. Okay, so that you can see everything perfectly. Okay, now you must see everything good. So at this graph, as you can see, this is the financial condition index. This includes almost everything in overall, in generally, how easy it is to get money from the banks, loans, all this kind of stuff like mortgages and stuff like this. And as you can see, once again, this index goes down significantly because money is just available. Like it's like no one wants this money. Everyone wants to give this money to someone just to get at least some like 0.0005% of interest rate of this, because no one knows what to do with this money. And I'm speaking about everyone. What I mean about this is the government, like agencies, like banks, and also like obviously people always, individuals always want money. We don't have this money that we just don't know what to do with them. But what I mean is the top this like segment of the every single country, which are banks, financial institutions, mutual funds and all this kind of stuff. This is what I mean about they have all the money which they don't know what to do with them. Okay, let me just put me back on the screen because otherwise it does not look good. At least I don't like it personally. Okay, and this is the next one. The next one is the IPO activity. So whenever you have so much money and whenever you see that it is so easy to access money, what some companies try to do, they see that everyone is investing in everything. No matter what you are doing on the stock market, almost everything goes up. If you create a company, let's go back 20 years ago. If you create a company and call it internet related company, your stock goes up 300%. If you create a company 1 year ago and you call it electric vehicles company, your stock price goes up 300%. If you create a company and say that you're a blockchain related company, your stock price goes 200%. Even us individuals, we do not have, obviously, we never have enough money. No one ever has enough money. Looks like no matter how much you have, you still want more. This is the hunger that's never filled. But anyways, when companies see that us regular individual investors, we have some free money in terms of stimulus checks that Americans were getting last year. They got 3 of them, if I'm not mistaken, which was a total of almost $5,000 of free money. And there was so many new people that came to the stock market. I think it's more than several million people came to the stock market just in this 1 year. That's why all this RobinHood, Charles Schwab, TD Ameritrade, the number of new users is like triple digits in comparison to the 2019, 2018. Companies see this, and what they do, they know that the consumers maybe are not the most well-educated ones, and they are ready to invest their money in almost everything, and they start doing IPOs. And you see there are so many IPOs in last year, and this is now confirmed by the graph. Just look at this yellow. No, all this is basically, it shows the number of IPOs. There is like, let me read this. Okay, so so as you can see, I forgot. Okay, let me reset. As you can see by this graph, the number of IPOs is incredible. Just starting with 2020, when you're thinking that the conditions are the worst, when the market is at its lowest, when no one wants to have money, when everything is in panic, then everything started to recover. And if you remember a couple of slides ago, I showed that economic surprise last year was extreme. It was like vertical, because everything was it was the fastest stock market crash, I think, in the history of the US stock market. We went down so fast, but we recovered to the previous levels and even doubled, even faster than any time before. And companies just simply started doing IPOs. IPO is basically free money. Some companies do IPO under normal conditions. For example, if they need to do some very big project, if they want to expand, if they need capital. The purpose of IPO is that whenever a company needs outside capital, so they sell part of their companies for exchange, obviously, for money, and then they use this money for projects, mergers and acquisitions, expansions, research and development, and stuff like this. But whenever companies see that everyone invests in the stock market like without even thinking, they know that if they offer part of their company to the stock market, they can just get all this free money, and even besides getting this money, them as a shareholders, their share price will be like up 50%, 100%, 200%, hopefully. So the purpose of these most recent IPOs, a lot of these new IPOs were of very low quality and not for the real purpose of an IPO, which is to fund some major project. Lots of IPOs last year was just basically just to get some money from us investors. Now I see a little bit of questions. So some of Mr. Araya says, and welcome back, Mr. Araya. I'm so glad to see you again. Hopefully our second friend joins us as well. So some of the IPOs could be pump and dumps. They can be. Of course, pump and dump is illegal. It does not mean that people are not doing for this, but yes. Possibly that some IPOs are pump and dumps, especially in the last year or so. I'm 100% sure that more than half of most recent IPOs were just because there was like an executive sitting in his office, and then there was like financial analyst or like director of finance. He went like, the stock market is so hot right now, everyone is buying everything, especially if it's an IPO related to blockchain or electric vehicles. We need to do IPO right now because they will buy our shares and we'll get rich. I'm sure this happened at least individual cases, but I'm almost sure that this happened at least once. Okay, and Af Alam says that buy, make money, have connections, make money, corruption is legal in USA. It's not officially legal, but I know what you mean. Buy everything. If everyone is buying, the stock market always goes up, because stocks only go up. Remember, this is number one rule in the stock market. Stocks only go up. They never drop, obviously. Okay, and the next slide now. This is the financial asset allocation among households, mutual funds, pension funds, and foreign investors, which basically means this shows where regular people like us and institutional investors, where they invest their money. And my face is blocking a little bit, but I'll just tell you, 50% of money on average, it's not like obviously applicable to every single person, but on average 50% of investments people hold in equities, which is basically stocks. 22% people hold in debt, which is how it's called, like bonds, and 12% people hold in cash. Whatever is the difference, like 50 plus 22 plus 12, it is 84 if I'm not mistaken. The rest 16%, it's the rest investment, like cryptocurrencies and all this kind of stuff, okay? But what it shows, that so many people are investing in the stock market, and this graph is very long. That's why maybe these ups and downs, they do not look significant, because this graph starts from 1990s. But as you can see right here in the end, when it approximately 2020 starts, it went down a little bit, but then it went up significantly, which basically means that people were having less than 40% of their investments in equities, and now they have more than half of their investments in equities. People are buying more and more stocks, and this is once again confirms what I was telling previously, that people just invest in the stock market sometimes without even thinking, because everything goes up. Okay, before I go, next one, buy houses. What Af Alam says, buy houses, Bitcoin, Tesla, cars, charge, credit, buy everything, everything goes up. Not financial advice, don't do it, I'm just obviously kidding. So, investors dialed back their use of leverage in July. And this is what I was gonna say in combination with this slide once again. So many people investing in equities, and so many people start to invest with leverage. Which basically means when the market crashes, let's say, so you do not use leverage, and leverage means it's borrowed capital. If you have $100 and just invest your $100, that's it, you are not using leverage. If market crashes 50%, you will now have $50, simple as that. But what leverage means is that you go to the bank, it's not happening like this, but it's just easier to explain and to understand it like this. You have $100, you go to the bank, you get $100 from them, and now you have $200, okay? But then, when market crashes the same 50%, now you have only $100, which you need to return to the bank, because this is not your $100. So you return this $100 to the bank, plus some interest, plus some fee, and if, okay, let's not even take fees into consideration, but if you have $200, which went down to $100, and then you return this $100 to the bank, now the same 50% correction made you be with $0 left. Leverage is very scary on the stock market. It might amplify your gains, but it might significantly magnify your losses as well. And besides, whenever you are on leverage and when stocks go up, everything is good. But whenever you're on leverage and stocks go down, you cannot just wait until the stocks start going up again, because sometimes margin call can happen. And margin call is, once again, I'm going to explain it, it does not work like this, but it's just easier to understand. Margin call is whenever you have a phone call, it's not like this, but just stay with me. You get a call from the bank and says, hey, your position is down so much, we are afraid for our money, we need to forcefully close your position because we want to get our money back. Which means that you cannot, being on leverage, wait until stocks go back up and then just make more money. If stocks go down significantly, lots of people will start getting margin calls on the stock market, which basically means they will be forced to sell their investments and exit the position. What happens when lots of people start getting margin calls and when they start selling stocks? Demand will be lower than the supply. There will be more stocks on the market and less people buying it, which means what? Stock prices will go even further down, which means what? Even more people will start getting margin calls, which means what? Even more people will start selling them, and this is the chain reaction, which means that the decline can be significantly fast, I mean. But at least a little bit good news that in July to August, people started to a little bit to get rid of the margin, because before this, as you can see, everything was almost on margin. So this is a little bit good thing that people started to get rid of margin, at least a little bit. And now consumer confidence index, which I was talking about like 10-15 minutes ago. As you can see, these two graphs, black one and the orange one, black is the confidence composite index, which just basically shows how confident are people, how much money they're spending, how much they believe in the economy, how easy for them it's to get rid of money and stuff like this. And the orange one is the S&P 500 performance, if you want to call it like this. Relatively, it was kind of the same. But guess what? Once again, 2020 happened, the stock market went down, consumer confidence went down significantly, because that's it, everyone was at home, everyone was afraid, everyone was desanitizing everything every 15 minutes, everyone was using masks, even while driving alone in cars and stuff like this. People were afraid, people were not going to do the haircuts, people were not going to nail salons. People are not going to the beach, people are not spending money. Consumer confidence went down significantly. And it was more or less relatively low for basically the whole time until recently. Then people started kind of feeling better, started feeling good, then Delta came. Consumer confidence, as you can see right here, almost in the very end, started going down again, because who knows how contagious is Delta? Will they be able to contain it? Will we be all safe finally, and stuff like this? But the stock market started going up, and it never went down since the middle of 2020. So what does this mean? Consumer confidence is down. People again start spending less money, which means once again what? Businesses once again start receiving less money. I'm not even talking about like Amazon and stuff like this, because this is online shopping. It even went up during the pandemic. What I mean about smaller businesses. Amazon is far from being bankrupt. We all understand this. But what I'm talking about is smaller businesses, which already can be on the brink of bankruptcies, and now even less consumers start using their services and buying their goods. And this is another stuff to confirm in combination with my previous slide where I was talking about consumer confidence. Now also people started even to trade less. This is the composite S&P volume index, which basically means the amount of trades on average, let's say, so every week, every month, every day, and stuff like this. So as you can see, approximately in March, when there was the biggest crash, there was so many trades for two factors. Because first of all, people were selling everything, and there was so many margin calls, which once again, you remember I was talking about this chain reaction of margin calls. So this went up so much because there were so many trades. People were getting rid of millions of stocks. And plus, people were buying millions of stocks as soon as basically we kind of felt that, okay, this is the bottom of the stock market. That's why the volumes were crazy about the middle of 2020. And since then, it was more or less in the downtrend. Also, the reason why it was so high in the middle of 2020, it was so many free money. Once again, stimulus checks, almost $5,000 of money that people never had before, and now they don't know what to do. People spend it on rent, on groceries, on utilities, on bills. Some people spend it on like exclusive like designer clothes and stuff like this. Some people just invested it in the market. Some people did it good, just invested in the index funds, ETFs, but some people just YOLO'd their money in GameStop and AMC and stuff like this. But that's the reason why there's so high volume trades in the past. Now there is no more stimulus. Now there is a new human infrastructure bill for $3.5 trillion, and it does not have anything about the next stimulus checks. So that's it. It's been 3 checks. Most likely there's not going to be any more checks for Americans. So that's it. Consumer confidence is declining. People start again worrying about saving money, getting rid of investments, maybe getting rid of risky stocks and stuff like this. Or maybe majority of people just already bought what they want and they just keep and hold their investments. So the volume of trading is decreasing, which once again, the demand is decreasing. And when demand is decreasing and supply is the same or even goes up, the prices tend to go down. Another thing to confirm my previous slide is the short interest. Shorting stocks, once again, for some of you who do not know, you can buy stock, you buy it for $100, you sell it for $120, you just made $20. Or you can short sell the stock. Right now the price is $100, you first sell it, and then you buy it back whenever the price reaches, let's say, so $90. So you return it for $90, so you made $10. This is what short selling means. It might be very hard to understand and comprehend, but during the times when people are the most confident about the stock market, crashes happen. Because crash happens when we least expect it. If people knew that, okay, crash will 100% happen in February of 2022, we will already see that people will start selling their positions and crash. It will, yes, the market will go down, but it will not go down significantly. It will not lose 30% in 1 week. It will just go down slowly, or maybe fast, I don't know. We never know when the crash is going to happen. But what I know is that lots of time crashes happen very, very unexpected. When everything seems fine, when everything seems like it's always going up. You remember internet .com bubble beginning of 2000s. This is when the short interest was so low. It was only 1.5% of the total stock market capitalization, like companies of shares. Only 1.5% of stocks were short sold. Only because people were like, okay, that's it. Everything internet related always goes up because stocks only go up. Everyone was like so sure, that's it. Short sellers, they gave up. Bears, they gave up. There's only bull cases on the market, and basically that's it. And then this thing happened. No one expected. Everyone panicked, and there was a big crash. Same thing happening right now. We know that stocks only go up. Jerome Powell, Federal Reserve, will keep printing money, Tesla to $5,000 per share, Bitcoin to $1 trillion per Bitcoin, stuff like this. Everyone starts to accept the fact that the stock market will always go up, which it will absolutely 100% know. Which means that we are now the least expecting anything crash related to happen. And you already know that whenever you least expect it, this is when it happens. I think a couple of more slides, so just stay with me. And why stock market is not crashing? In fact, it already did, by the way. And I want to do a presentation in the next couple of weeks. I think next week I will do my new portfolio review. And after this, I want to do a presentation, live stream, that the stock market crash already happening right now. If you see on the S&P 500, it always goes up. Why? Because 22.8% of the S&P 500 depends on 5 companies, which are Apple, Microsoft, Amazon, Google, and Facebook. These 5 companies, they bring the stock market up, the S&P 500, because just these 5 companies, S&P 500 is the composition of 500 companies. And just top 5 of them is responsible for 22.8% of the whole weight of this index. And these are the companies, if you open their graphs, every single one of these 5 companies, it more or less goes up, except Amazon. Amazon, I think, is down in comparison to the beginning of 2021, but it's not significantly down. It's like minus 2% or something like this. The rest, every single company of this, it's up. And these companies, they boost the whole S&P 500 up. You open all the other companies, which I will do during my next live stream, and I'll show you what I'm talking about. But if you open like Corsair, I don't know, Intel, 3M company, Lockheed Martin, all this kind of stuff, if you open these companies, these are the companies which are already 10, 15, 20% down from their maximum prices in approximately end of February and March and stuff like this in January. Just trust me, after the live stream, which I'm going over like in 5-10 minutes, just open some of the smaller companies, and most likely majority of them will be down 10, 20 or even 30% from the maximum numbers. Which means that the stock market crash is kind of happening. It just waits for the rest 5 biggest companies to start crashing, and then it's going to be a huge collapse. This is once again to confirm the fact what I'm talking about, the Shiller PE ratio, the PE ratio of the whole stock market basically. And right now, on average, PE ratio is good to be around 15. As you can see right here, median PE ratio, mean is around 15, 16. Yes, it is good to see when companies are around this ratio. But now, on average, every single company of the stock, on the S&P 500 is around, of the whole stock market is around almost 40. Which is 3 to 4 times more than it's supposed to be. Companies are 3 to 4 times more overvalued than they need to be, and on average. So this means that yes, we are not as high during as dot-com bubble, but we are getting there. And this is once again the confirming that stock market is just crazy. The green line here is the GDP of the US, and it's go up pretty much flat line, like flat line, but it always goes up. And the blue line is the total stock market. It's not the US, it's the total GDP of the world and total stock market. And as you can see, it was kind of relatively the same. Sometimes total stock market capitalization was a little bit below world GDP. Sometimes it was a little bit more than this. But since, once again, printing money happened since the pandemic, it started to go up so much significantly. Right now, total stock market is 2 times more expensive than the whole world's GDP. And this is, if it does not make you be like questioning what's going on in the market, then I don't know what will. 2 more slides. So just today came the report that the jobs report disappoints. Only 235,000 positions were added in August. The expectations were 720,000. This is from the CNBC, so this is like a relatively reliable source, as all my previous slides were. All of them were reliable sources. But once again, Jerome Powell said that he will stop printing money as soon as he sees that jobs are getting back to normal. And he is already printing money, jobs are getting back to normal, he was still printing. And now this report comes out. Expectations were that in August we're gonna have 720,000, but it came 3 times less than even expected. Jerome Powell right now is dancing in his office. He's like, yeah, I can continue printing money. I'm gonna be until February. No one is gonna fire me. Then they're gonna re-elect me, and then I'll crash the stock market. Right now, this makes Jerome Powell, I'm sure, very happy, because now he has all the reasons to continue printing even more money, which, if you remember, does not benefit us at all, and this will exponentially just go down. The more money he prints, the less benefit they will bring, and now he will continue printing the money. He might even print even more money after this report. Once again, this just came today, so the reaction of him, his official response, we can only see the next week, I'm assuming, or maybe even next month, we'll see. But he is dancing right now, because now he can justify all the money printing. And this is why we came here for. You already see so many factors saying that the economy is on the brink of self-destruction. I was gonna say it. Every single thing which is a black swan can cause the stock market to crash. And black swan, for those of you who just joined me, black swan is the event on the stock market that something unexpected happens, like literally no one even expected this, and then this start chain reaction of events, which eventually brings down the stock market like 20, 30, 40, 50%. This is my today's prediction, what can be potentially the black swan of the stock market collapse, which is once again was already on the brink of doing so. August 30, which is a couple of days ago, I think, the SEC chairman, Gary Gensler, he said that he is thinking about banning payment for order flow. Payment for order flow is the 80% of money. RobinHood is the investing trading app, usually the one that Americans using, and we are talking about US stock market, obviously. 80% of revenue for Robinhood comes from payment for order flow, which is pretty shady technique. It's not officially banned, it's kind of legal, but it's a little bit shady. And think about this, and by the way, I do have a video about payment for order flow, what it is on my channel. It's like only 2 minutes video, very quick one. So if you do not understand right now what is this, after I finish in 5 minutes, go ahead and watch this video and you will 100% understand this. But briefly, payment for order flow, this is what it means. Whenever you using Robinhood, and let's say so you're buying shares of Apple, and you would think that Robinhood is the one who buys shares for you and then transfers these shares to your account. But no, this does not happen. Instead, Robinhood gets your order for shares of Apple, passes this to the market makers, for example, Citadel. And then these market makers, they purchase these Apple shares that you ordered from Robinhood under their prices, which can be in fractions of penny higher or lower than you wanted to buy it for. So if you're just a regular investor buying one share, you will not even see the difference. But if you're buying millions of dollars worth of stocks, this can potentially make you lose like $100, $1,000 in worst case scenarios. No, theoretically speaking, okay? So, and they make their transactions based on their own bid-ask spreads. And bid-ask spread is the difference between bid price and ask price. Once again, I have a video on my channel about what is bid price, what is ask price, and even the video about what is the difference between bid and ask price. So if I start explaining it right now, it's gonna take 2 more hours. So, and then they make this money, market makers, on this bid-ask spread, which can be less than a penny per share. And then when they return the shares with our ordered shares back to Robinhood, for this opportunity for them to make money for our orders, they pay Robinhood money, even like fraction of a penny per share, let's say it's like this. And Robinhood, by doing so, by rerouting our orders, made 80% of revenue, has been making 80% of the revenue basically since the beginning. And this is why this stockbroker is so-called free. It makes money through payment for order flow, it makes money through options, it makes money from cryptocurrencies and stuff like this and that. But the biggest one is the payment for order flow. Now imagine if this thing gets actually banned. Robinhood, and it's not just the one, Charles Schwab, in order to stay competitive, TD Ameritrade, all of them, they started to offer free, commission-free trading just to be competitive with Robinhood, which basically means that they're also using payment for order flow. So many people started investing because I can buy shares and I do not need to pay any commission for this. Because in the past it was like for every trade you need to pay $5 for every trade. You make $100 per month, you're paying $500 per month just in fees. And now it's everything is free. Just imagine if they ban this, what of the first things that these brokers might do to start to continue getting money, to continue making money? They might bring fees back, which basically means all these people who are like, oh, it's like free to trade money, investing is so easy, there is no commissions. Some of this, I'm not saying all of them, but some of people will stop investing just because of the fees, just because they started investing because it was so easy and no fees. But now some people will stop investing. Stopping investing means what? Once again, less demand, more supply. Stop investing means they're gonna sell their shares, or they're just gonna hold them, not do anything, not do any trading volume at all, and they're just gonna not affect the stock market at all. Less liquidity, more volatility on the stock market, and volatility is going to be bad volatility, because supply, there will be more shares in the market than those people who are going to be buying the shares, because retail investors, they're a very big significant portion of the market participants. Some of them will stop trading. Less demand for the stocks, less demand, more supply means what? Stock prices go down. And now we take all the other things into consideration. Market is overheated, money does not do as much good as anymore, consumer confidence is all-time lows right now, people are not investing in the stock market almost as much as they used to 1 year ago. So many people are still on leverage. As soon as the prices go down, the share prices, go down, some people will start getting margin calls. Margin calls means that they will need to sell their shares, means that the prices will start going down even further. Even more people will start receiving margin calls. More and more people will be losing so much money, 50, 60, 80% of their portfolios will be gone in 1-2 months. Share prices are down, businesses are not getting money, more businesses started to go bankrupt. Margin calls on the left, businesses filing for bankruptcies on the right, economy is overheating, money does not worth that much anymore, inflation is in double digits. All this combined, what we get? I think you know the answer. So I think it was pretty informative. 1 hour passed, as always, it feels like in 5 minutes for me, at least personally. But this is my stock market prediction. I don't know what's gonna happen, but this is what I think can be the catalyst for the stock market crash, which can happen within next 6 to 12 months. We're gonna see. And the more predictions I make, the more chances at least one of them will be true, which then I can just clip it, put it on my YouTube channel and see, told you, I predicted the stock market crash. So this is how it is. Any good news, Mr. Araya asking? Yes, the leverage is going down, so people are not using too much leverage. Basically, that's the good news. That's the first good news. The second good news that the stocks always go up. Stocks always go up until we have some kind of correction or recession or black swan event. This is the second good news. And the third good news, if you zoom out, yes, that's the end of my presentation. So this is what you see right now. This is the S&P 500. No matter the corrections, no matter the recessions, if you zoom out everything, dot-com bubble, we survived it. 2008 financial crisis, we survived it. Coronavirus, pandemic, we survived it. No matter what's happening, if you keep holding money, just investing, dollar cost averaging, as long as you have 30, 20, 15 years in your portfolio to just keep holding your investments, you will survive through everything. If you are still young, just keep invested. Don't try to time the market. I don't know when it's gonna crash. I don't know how severe will gonna be the crash. I don't know how fast it will recover. But what I know is that if you still have 10, 15 years, don't worry about this. Don't listen to people. Don't listen to me always saying that this is gonna be Armageddon. It might be, but it might not, I don't know. But eventually it will. Because all the stock market predictions, they are correct. The only thing which is different is the timing. Because the crash will happen. It will happen 100%. The only question is when. And this is what I'm trying to answer, when it's gonna happen. I am not gonna sell anything. I'm just gonna, when the market is going to happen, I'm gonna buy more, because stocks will be more cheap. And that's it. I'll be holding my investments for 30 plus more years. And as you can see from this graph, which only starts from 2010, we are just going up basically no matter what. We are surviving through everything. So my advice is just don't listen to anything, keep invested in good companies, especially in the good ETFs like this S&P 500 ETF or total stock market ETF, and you are good to go. And Earth Sound says the market is horrible. And on this note, I say that I do agree, the market is horrible, but stocks only go up. The correction will happen, I don't know when, and my prediction is February 2022. So thank you so much for watching, thank you so much for staying with me, thank you so much for questions, and until next Friday.